We're going to win so much, you may even get tired of winning. And you'll say, please, please, it's too much winning. We can't take it anymore. Mr. President, it's too much. And I'll say, no, it isn't. We have to keep winning. We have to win more. We're going to win more. We're going to win.
Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks moved lower on Thursday as the market received bearish data on jobs, as a report from the global outplacement firm Challenger, Gray and Christmas showed last month was the worst October for layoff announcements since 2003. The data prompted more questions about the health of the labor market, especially in light of the government data blackout amid the ongoing federal shutdown. And stocks, some were red, some were green, such goes the market, but broadly we were red here today. We can see the mega caps, Amazon, Tesla, Meta, Nvidia, Microsoft, all of the infrastructure was down just on the back of this news. Valuation concerns playing into this, a bit of profit taking playing into this. We can see software was also very red. The only green we saw probably had to do with earnings and some defensive sectors. You could see Google was kind of flat here, as well as Apple. They held it together for the mega caps, but that was it. ABGO, I guess, was kind of flat. Financials were mixed. So, I mean, JP Morgan was green, Bank of America was green, same with Berkshire. Sort of the big names in each sector really is where capital is going to now, especially if we are going to get labor market data concerns. Then we have some outperformance here from healthcare, energy, utilities, consumer defensives, I guess. Some of these defensive sectors. This is what the sector analysis looked like. In aggregate, there was only one green sector, that was the XLE, the energy sector. And that's because there's some things going on with oil in Russia. We'll talk a little bit about it later on in the video. GLD gold was up 0.1%, so a little bit of a safety trade, safe haven trade, I should say, but then every other sector was green. You could see some of the outperformers here in the defensive sectors like utilities, real estate, right? They outperformed, but still red on the day. And then we had stuff like the SPY, the Russell 2000 down in excess of 1%, led by technology, consumer discretionary stocks really taking it on the chin today, comm services as well. Through and through, all in all, it was just a very ugly day for the market, led by selling in the growth component of the market. Large cap growth, mid cap growth, small cap growth really took it on the chin. Mid cap value saw some green. That was the only green we saw. Value in large and small took it on the chin. Core was red through and through. Large cap growth was the worst performer here, led by stuff like Nvidia, Tesla, Amazon, and all of this red came from a couple of key things that happened today that really spooked the market. Number one, Challenger job cuts came out, right? And it was the highest level we've ever seen going back to early 2003, right here. Look at this level, absolutely insane. Worse than what we saw in 2020, 2018, 2008. And the market just got really spooked by this data because we don't have non-farms. We're supposed to get non-farms tomorrow, and we're definitely not going to get that data. Why? Because the government is still shut down, and Speaker Matt Johnson came out and saying he's less optimistic about the shutdown. We're looking at potentially a deal coming together at the start of 2026. Airports are about to close. Things are getting really serious, and I urge Democrats and Republicans to actually come together for this. Christmas is coming up. People don't have jobs. We're going to start seeing this in the data. It's not about the stocks anymore. People need to get their money. Christmas is coming up. People have children. Work together. Compromise. I mean, holding out on both sides of the aisle. This is helping nobody. The government shut down. Both the Americans are hating you right now, guys. Get together. Please do it quickly for the good of the American people. I hate to go on a rant like this, but this needs to happen sooner rather than later. So Trump, Democrats, Republicans, it's both sides. Both of you need to come and find a compromise in the middle and get the government reopened, and let's continue business as usual, because this is absolutely unacceptable at the moment. At the same time, what we're also seeing is that the Supreme Court is talking about Trump's ruling on tariffs, and this is also spooking the market, because let's say if the tariffs go against Trump, it looks like the US would need to refund approximately about $1 trillion or $800 billion worth of revenue and deals. So we'll see how this, there's a lot of questions about the legality. Is it a tax? Only Congress can implement tax. I don't know. but this is where the market is right now. So all of these things together help the market move lower, along with valuation concerns. And then we also got some very cryptic comments from Jensen Huang. He came out and said and warned actually that China will win the AI race against the US due to a more favorable regulatory environment. This is not what you want to hear from the poster child, the godfather of AI. And again, we saw Nvidia down 2.39% on the back of this. At the same time, we saw this news for OpenAI, Sam Altman looking for a government backstop or quote a bailout if things go south for OpenAI. And then David Sachs, the AI czar, came out and said there will be no federal bailout for AI. The US has at least 5 major frontier model companies. If one fails, others will take its place. And yeah, all of these things together meant stocks were down, AI stocks were down, tech stocks were down, the mega caps were down, and just the market as a whole fell. We also got some really terrible earnings here from consumer company Celsius Holdings. Now, the company reported adjusted earnings of 42 cents for the quarter, surpassing the expectation of 28 cents. Revenue reached 725 million, exceeding estimates of 715 million. So we got a double beat, right? However, the growth was primarily driven by the recent acquisition rather than organic performance. So Alani Nu, the newest acquisition, grew 114%, whereas the Celsius brand only grew 13%. And Rockstar Energy, which was acquired in August, actually saw a 9% decline. So the market not liking the overall metrics and the fact that the company is growing via acquisition. DoorDash, this was actually kind of crazy, was down 15.86%. Now, the company missed earnings by a lot. The company was expected to report 70 cents in earnings per share. They came out and reported 55 cents, a massive miss. They beat on revenue. So there's something on the expense line going on, somewhere in the expenses that's really equating for this massive loss right there. And then the company came out and said they will spend several $100 million more in 2026. And the Deliveroo acquisition will impact earnings after the market thought it was going to be earnings accretive in 2026. And yeah, market not liking this, the stock falling 15.86%. And Robinhood, after reporting stellar earnings, beating on the top line, beating on the bottom line, revenue growing 100% year over year, was also down 7.88%. Now, I think the big reason why is because transaction-based revenue, which is a proxy for trading activity, came in at 730 million. The market wanted 739 million, and now we're seeing the stock trade down. You know, these lofty expectations, the management team simply could not meet those expectations. And then for everything we saw today, there was 4,200, nearly 4,300 decliners, 2,000 advances. We saw inflows in the New York Stock Exchange, outflows in the Nasdaq 100, the S&P 500 red on the day. Market momentum not looking that great, but the longer term averages continue to remain very, very strong. We're just missing the shorter term and medium term averages, as you can see right here. So ultimately, right, short term, medium term, the market not looking that great, but in the very long term, you got the tick of approval from the market right here and still a dip buying opportunity. But let's hop on the charts. Now guys, looking at the charts now, very red day here for the markets in aggregate. The S&P 500, the Nasdaq, the Russell 2000, high beta really taking it on the chin. You can see here the Russell 2000 down 1.296%. Mid-caps outperforming as well as the equal weight, only down 0.41%. We can see the S&P 500 also down less than 1%. But yeah, mega caps, tech and high beta really taking it on the chin. Internationally, China's outperforming after those Jensen Huang comments. That's about it. This is the KWEB, this is the technology ETF, but everything from the Middle East to India to Asia to Europe are all down very big on the day. Crypto down as well. Bitcoin and Ethereum not acting well. Ethereum is in free fall right now, but Bitcoin still holding the $100,000 mark. Yields fell on the back of everything we saw today, right? The dollar dumping, volatility ticking up this is the exact price action you would expect given today's trade. And then gold is up, silver slightly up, TLT, treasuries roaring, right? And again, that is a safety trade. That's ultimately what's happening. But let's talk about the S&P 500. Let's quickly go to the one-day chart right here. I mean, look at today's price action, right? We could see that we are actually bouncing off the lows right here. So dip buyers came in here, came in here. Now, sellers still waiting for the day, don't get me wrong, but we definitely are seeing the market move higher towards, into the end of the day right here. However, we'll see if we get an end of day dump or if we sort of just consolidate and close right here. Constructive price action coming off the lows, but in aggregate, when you look at today, a very ugly day through and through. Now, when we hop back on the weekly chart, guys, we do have to put this into context, right? Things look good on the weekly chart. Like, you do not want to get bearish here. You ultimately just want to be buyers of dips. Now, we're holding out. We've been talking about this for a while. For a dip here at the 6130 area, this is where we used it as resistance previously right here. We broke above right here. We do know that resistance eventually turns into support for us to move higher, and we could see it very, very clearly right here. We had a double top resistance, tariff tantrum move, got all the way back here, saw a little resistance, and then when we broke above, it was onward and upward. Now, this is the weekly chart, don't get me wrong, and you can see the weekly candle not looking that great, down 1.27% for the week here in the S&P 500. Going into the daily chart, we can see we are in a daily downtrend right now. Yesterday, or the last couple of days, I said there's two schools of thought which I see right now. We are either going to bounce right here and continue to move higher, which we tried to do yesterday, or we're going to break below and go lower. Right now, the market is looking like we had a little bit of fake out yesterday, right? And now we're seeing a bit of price action move to today's low. So if we actually use this as resistance, let's say tomorrow, we actually then continue to move lower. And where should we find support? In the shorter term, it's going to be the 65.50 area right here. It's going to be these lows. So ultimately, this is the main area, and then this is the secondary area. If we break below here, then we can target 6130. But I would say if we continue to move down lower, let's actually just change this to a different color. If we continue to move down lower right here, we should find support at the 65.50 area and then make the next move to the upside or the downside. We'll assess it if we get there, but we do need to see a weekly close below this line right here, called the 76.50 area. We get a weekly close below that, we can then target the 6,500 area. Not looking good for the S&P 500. The Nasdaq 100, very similar situation. We're at this very, very key area, and that's the same for all of these names right here. And yeah, look, we do have strong areas of support at the 22,000. Now, it is quite a bit of a dip there. If we do take a measured move, you're looking at a 10% plus move, 12% for the Nasdaq 100. If we actually look at the S&P 500, it's not quite as dramatic. You can see it's about a 9% move to get to those levels. For the Russell 2000, right, that level is right there. I think we're going to find support right here for the Russell 2000. I think the market, sniffing out rate cuts, I think we are still going to see our performance here in small caps and mid caps. But the rotation is underway, and that right now is a rotation from probably riskier assets into more defensive areas of the market, as well as stuff like treasuries and gold. They've outperformed cryptocurrency. Now, Bitcoin, consolidating right here at this 103,000 area. Now, we've said that as long as Bitcoin holds this area right here, we probably remain bullish. We're on the precipice right now. So bulls need to step in right now. It's do or die, now or never, right? This is where you step in for us to move higher. If not, we probably can see definite lows in the low 90s, somewhere around there for Bitcoin. Ethereum, I think we're going to see probably 3,000, 2,700, somewhere around there for Ethereum. It's clearly broken below this trend line pattern right here. It's broken this area of liquidity right here. So what does that mean? Probably means we probably go lower. The next area of support, I would say, for Ethereum is right here, somewhere around this area. So it's a 2,600 area. You could probably target the highs. You could probably target the highs right here. I guess you could say maybe it's 2,700, maybe it's 2,800, but that is your next leg of support here for Ethereum. Now, we could bounce here. Anything can happen if you actually do measure it, like from the peak, the all-time highs, to probably where we are right now. It's about a 30% move. So very, very volatile. That's what you expect in crypto right here. Ultimately, right, cryptocurrencies, I am still exceptionally bullish on this entire space. And while retail isn't that bullish, if you look at the institutional flows, right, institutional clients are still actually very, very bullish on this asset class, and they're still trying to get it into their portfolio. So I do think there's long secular tailwinds for cryptocurrency to continue to move high, especially as Ethereum and Bitcoin become very well established assets. Now let's quickly look at the 10-year yield. We're finding very crazy resistance right here in the 10-year yield. If we continue to see weakness in the economic data, yields are going to move lower, and that's ultimately why we're cutting rates, right? The Fed said, hey, there's some issues with the job market. That's why we're cutting rates. So as long as if we continue to get weaker data, we probably will get a December cut. If we continue to get stronger data, we'll take that cut. Maybe it might not come off the table, but the expectations or the probabilities of it will move lower. The 2-year yield sitting at 3.5%. So the market probably saying right now, yeah, there's probably about another 50 basis points worth of cuts in this market, at least in the near term. Now, the dollar actually fell here. Now, we were expecting the dollar to probably move a little bit higher off these lows. We said 96 was looking a little bit cheap for the dollar. Everybody was bearish on the dollar, and the dollar has since risen. Now, I do think we're probably going to go higher. I think we're going to see 101, 102 for the DXY before we probably roll over into 2026. So we're going to see a little bit of pain right here, but as long as we hold this 98 area, the dollar will continue to move up. And I think that's probably why we're seeing a little bit of weakness here in some of these risk assets. I mean, if you look at the dollar, right, the dollar has actually moved 3% off the lows. That's a crazy move for something like the dollar against the euro, the yen, just all of these currencies, the Naira, everything in between. So it's a pretty strong move here for the dollar. It makes my portfolio, which is priced in Australian dollars, and I hold a lot of US assets, it makes my portfolio look good, but for risk assets in general, it's not that great. Now guys, I am still a big believer in the AI trade. I think the names you want to hold right now in NBA infrastructure names, APLD, that's one name. EOSE, they reported earnings, they were actually green here today, right, up 6.43%. I've been talking about this name for a while. And then SIFR, Cypher Mining. Now, Cypher Mining took a bit of a dump here, 8.66% down. I think this is probably another name you want to be in my personal opinion. $20 cash secured puts us selling for $2. Absolutely insane premiums looking out to December. And then, guys, on the healthcare front, I do like Oscar Health. They reported earnings, great earnings, by the way. Now, the stock is pretty much flat here, up 2.99%, but I at one point, it was up 6% to the $19 area. I do think Oscar Health is probably going to see these $23 mark again. So yeah, right here for Oscar Health, I think this is a great place to hide if you're looking for a healthcare name. So yeah, these are the 4 names that I really, really like in the market right now. I hold cash secure puts on all of them. So yeah, these are the individual names I do like. But ultimately, guys, look, we're still bullish and we're still buying dips in these big tech names, these big infrastructure names. The AI trade is the only trade in town right now, and you just don't want to fight the trend. And diving into sentiment, this is the AAI sentiment survey. And despite ongoing concerns about growth, specifically in the market, the AI trade valuations, as well as political uncertainty vis-a-vis tariffs, AAI sentiment shows rising optimism, as you can see right here, at least from 4 weeks ago to today. However, we did tick down in bullish sentiment from last week into this week. However, we still are above the historical average here with bullish sentiment, which is about 33%. So bullish sentiment is still elevated, bearish sentiment slightly elevated as well, and pretty much we're seeing a lot of people here in the neutral camp pick a side, bullish or bearish. And this suggests that both investors, bears and bulls, are looking past near-term risks, betting that the market will either remain resilient and recover or potentially fall. Who's going to be right? I personally think the bears. Why do I think that? Because when you look at earnings are simply moving onward and upward. They're moving higher. These are quarterly earnings estimates, and you can see the stair step higher. This is what you like to see, and this is telling us that analysts came into bearish and are now playing catch up. However, there are some concerns we do have to be worried about. One of them is breadth. In the last couple of sessions, the S&P 500 notched significant outlier measurements of market breadth. Both in October 28th and the following day, the benchmark posted modest gains. All was little changed, but the so-called advanced decline index was deep in the red, and this just goes to show the index composition, with the mega caps making up most of the market cap and size in the index. And as long as these mega caps stay this big, expect the market to continue doing this. In other words, to continue having very weird movements. It's officially a feature, not a bug, considering market cap weights. Now, looking at the macro, guys, something that's very, very interesting. When you look at the US macro regime model, this is from macro bond, you see something very, very interesting. Inflation has pretty much taken a massive dump right here, while growth and liquidity have both remained resilient, and liquidity actually increasing a little bit. So this is telling us that we probably are going to see a lot of deflation into the end of the year, at least if this is correct. And if growth remains resilient, we should start to see the labor market pick up. And we can see that with the private payroll data that came in at 42,000 here for October. We were looking for a negative 24,000 figure. We came in at 42,000 growth. I think the market, or the labor market, has troughed and now it's onward and upward. However, manufacturing and stuff like trucking is showing us renewed optimism. Things are not all good in this economy. In the latest Bloomberg truck stop truckload survey, the respondents expecting a rebound have actually fallen to the lowest levels since last fall. So this is not a good sign. It means that the underlying economy, there's some good, there's some bad. We just have to see what the data tells us and assess accordingly. But I think as long as GDP growth remains resilient, inflation comes down, and the labor market remains solid, I think that is the green light for us to rally. Now, talking about data, tomorrow, potentially we could get non-farms. Again, if the government opens, we'll see. Anything can happen overnight, but we should get October and September non-farm reports. The unemployment rate, which we're looking for a 4.3. Here in October, we're looking for 4.4. That's the forecast. Very interesting. We'll see if we get that data. We're also looking for the average hourly earnings month over month, year over year, the participation rate as well, and then we'll get Michigan consumer sentiment tomorrow. Myron is speaking. He's going to talk about how we need a rate cut in December, and then Williams and Jefferson are going to toe the same line that Jerome Powell is, in other vis-a-vis a rate cut is not fully certain. There's nothing with regards to earnings tomorrow, guys, and if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button, and leave a comment for the algorithm. Cheers.